I absolutely love a good corporate turnaround story. And let me tell you, software giant Unity is currently engineering one of the most fascinating narratives in the entire market. Today, we're breaking down their highly anticipated August 2026 earnings transcript to figure out, is this multi-year turnaround finally speeding up, or is the fundamental business actually slowing down? We're going to look way beyond the headlines, analyze their real financial metrics, debate if the stock is overvalued, and figure out exactly how this tech giant is trying to reclaim its crown. To understand exactly why this turnaround matters so much to investors, you really have to grasp the sheer scale of their competitive advantage. Unity's engine currently powers roughly 70% of today's top-grossing mobile games. In the software investing world, we call this an impenetrable moat. This isn't just about having market share. It's about incredibly high switching costs and total ecosystem lock-in. Basically, once a studio builds a live service mobile game on Unity, migrating that live code to another engine, it's virtually impossible without completely breaking the game. That 70% footprint gives them a foundation that is almost irreplaceable. So here is our agenda for today. First, inside Unity's business model. 2, missteps and fierce competition. 3, the 2026 strategic turnaround. 4, AI and the vector platform. 5, future frontiers in XR. And finally, forecasting Unity's road ahead. Starting off with Section 1, inside Unity's business model, create versus grow. From a financial modeling perspective, Unity's business is literally split into 2 distinct halves, and they have very different profiles. First up, you have the create side. This is the foundational game engine software, where developers actually go to build their interactive experiences. For an investor, create represents sticky, highly predictable, recurring SaaS revenue. Then you have the grow side. This is their advertising and monetization platform designed specifically for user acquisition. Grow is volatile, usage-based ad tech revenue. The overarching investment thesis has always been that the sticky SaaS create side funnels users directly into the highly profitable, but again, very volatile, grow advertising network. Now, the classic industry comparison is always Unity versus Epic Games. Unity dominates the mobile and indie sectors with a 27.2% overall market share, and they prioritize high accessibility and rapid prototyping. Epic's Unreal Engine holds a 16.2% share, but they absolutely rule the premium AAA graphical space. But look, as growth investors, we have to look at how this actually impacts gross margins and capitalization. See, Epic has a private market valuation structure that's largely insulated by the massive, proprietary cash cow that is Fortnite. Unity, on the other hand, is public. That means its gross margins are heavily scrutinized every single quarter, and they are overwhelmingly reliant on that volatile grow ad tech segment to fund their ongoing engine development. Moving on to Section 2, missteps and fierce competition, the 2025 crash. So, plagued by immense backlash from a highly controversial runtime fee pricing model, the company's stock crashed a brutal 60%. But let's look at the actual financial fallout here, not just the PR disaster. When management tried to force through a fee based on game installs, they completely broke developer trust. Financially, this translated directly into acute developer churn and the loss of extremely lucrative LiveOps enterprise contracts throughout late 2024. By the time they issued their Q4 2025 guidance, this mass exodus resulted in a massive revenue air pocket for early 2026. It sent the stock tumbling from roughly $49 all the way down to under $19 a share. Just a brutal drop. And to make matters worse, simultaneously, competitor AppLovin captured roughly 80% of the mobile ad mediation market via their Max platform. To really understand why this happened, we have to look at Unity's disastrous merger with ironSource. Internally, that merger just failed operationally. They faced massive integration costs and severe tech stack clashes between the 2 ad networks. While Unity's engineers were bogged down trying to stitch these incompatible legacy codebases together, AppLovin's Max platform algorithms aggressively outpaced them, optimizing ad yields for developers at a far superior rate in 2026. AppLovin essentially suffocated Unity's grow revenue engine simply by being technologically faster. Which brings us to Section 3, the 2026 strategic turnaround, the year of subtraction. Under new leadership, Unity initiated a ruthless restructuring phase dubbed the Year of Subtraction. They canceled the runtime fee, wound down the dying ironSource ad network, and reduced their workforce. This sequence of aggressively cutting dead weight throughout early 2026 perfectly sets the stage for the pivotal August 2026 earnings call, where the market finally got to see if these subtractions actually translated into a stabilized bottom line. And the data from that August 2026 earnings transcript is really where this entire turnaround thesis either lives or dies. The critical question for investors was whether the preliminary revenue beat in Q1 slowed down or sped up by Q2. Well, the August transcript verified that the momentum actually accelerated. By shrinking their footprint and focusing on core competencies, they didn't just stop the bleeding. They drove top-line acceleration, with Q2 revenue coming in at $530 million. This proved that their streamlined operations were successfully recapturing those higher-margin enterprise contracts that had previously turned out. As part of this rebuild, they introduced a brand new reporting category called Strategic Grow, which strips out the sunsetting ironSource assets and the divested Supersonic publishing business. But as experienced investors, we have to view this with a highly critical eye. Stripping out dying lower margin assets mathematically and kind of artificially boosts your overall margin percentages. Whenever a company tells you to look at adjusted strategic numbers instead of standard GAAP accounting metrics, you've got to be careful. They're essentially asking Wall Street to ignore the massive capital they destroyed in the ironSource acquisition and focus solely on the shiny new engine. Let's look at that shiny new engine in Section 4, AI and the Vector platform, the growth engine. So while total grow revenue did show acceleration, the non-strategic assets acting as a financial drag actually present a really strong bear case for overvaluation here. If these legacy assets continue to drag on the broader balance sheet for the next 4 quarters, you have to seriously ask if the core business is truly strong enough to justify Unity's current market cap. Bears argue that despite the restructuring, Unity is fundamentally losing market share in the wider ad tech ecosystem, and that valuing the entire company based on a small, hyper-growth AI segment completely ignores the very real structural decay happening in their legacy systems. But on the flip side, the bulls will point directly to this 48% year-over-year growth in Strategic Grow, which is powered by their new AI-driven Vector platform. To justify this incredible growth rate, you really have to understand how Vector works for a developer. Instead of basic demographic targeting, Vector uses machine learning to analyze real-time, sequential in-game behavior across Unity's massive 70% market share. It essentially predicts the lifetime value of a player on the fly, allowing developers to bid for high-value users with absolute pinpoint accuracy. That technological leap, that is what is driving this explosive 48% surge. With Vector revenue up 80% year-over-year, we hit the absolute core of the valuation debate. The major reason to invest is that Vector is an undeniably powerful proprietary AI model trained on exclusive ecosystem data, making it a formidable weapon against AppLovin. However, the glaring reason this stock might still be overvalued is its total over-reliance on this unproven AI ad model operating within highly privacy-restricted iOS and Android environments. Think about it. If Apple or Google tighten their data privacy frameworks even further in 2027, Vector's predictive power could be instantly blindfolded, severely kneecapping that 80% growth narrative. Section 5, Future Frontiers in XR, Beyond Mobile Gaming. To truly see if Unity is undervalued, you have to look past gaming entirely and evaluate long-term macroeconomic trends in the US economy. Right now, the US is undergoing massive infrastructure modernization and a secular trend of reshoring manufacturing. Because of this, Enterprise XR, specifically building digital twins of physical infrastructure, is a massive underpriced tailwind for Unity. While consumer XR is suffering from hardware fatigue and insane price tags, the enterprise side is perfectly positioned to leverage lighter, upcoming hardware to drastically cut costs in US industrial operations, making Unity's real-time engine vital for the broader economy. Let's look at some detailed examples of how US industrial sectors are actually utilizing this today. Auto manufacturing floors are using Unity's digital twins to simulate robotics and optimize assembly lines before pouring a single ounce of concrete. US utility companies, they're simulating complex electrical grid management in real-time 3D to train engineers safely. By deeply embedding their software into these high-value industrial workflows, Unity is directly challenging legacy incumbents like Autodesk, attaching itself to the trillion-dollar US reshoring and infrastructure boom, which significantly diversifies their risk away from just mobile gaming. And finally, Section 6, Forecasting Unity's Road Ahead, the Path to Profitability. To truly value this path to profitability based on the August 2026 data, we must introduce the PEG ratio. That's the price-to-earnings growth ratio. Now, do not confuse this with the standard PE ratio, which only looks at current price relative to earnings. The PEG ratio divides the PE by the company's expected earnings growth rate, giving us a much clearer picture for high-growth tech stocks. In August 2026, Unity's forward PEG ratio dropped to roughly 1.1, whereas peer ad tech giants like AppLovin were trading at a PEG closer to 1.8. This indicates that, when factoring in their massive expected earnings growth as margins improve to 27%, Unity is actually trading at a significant discount to its peers. Looking ahead, we have to aggressively model out multiple exhaustive scenarios for 2027. Let's break them down. In our bull case, the Vector AI platform successfully scales, capturing 40% of the ad mediation market back from AppLovin. Combined with enterprise XR adoption, GAAP profitability absolutely explodes, pushing the stock well past $44 a share. Now, in our base case, we see a slow, margin-driven recovery. Top-line revenue stays flat around low double digits, but disciplined cost-cutting keeps them profitable, resulting in steady annualized returns of about 9%. Finally, in the bear case, AI ad tech yields face severe diminishing returns. AppLovin retains its monopoly, and the legacy ironSource assets continue dragging on the balance sheet, forcing the stock back down into the low 20s. Ultimately, the investment thesis really comes down to weighing the existential threat of AppLovin against those 2027 scenarios we just detailed. Unity possesses an undisputed 70% market share in game creation and is wielding a highly disruptive AI tool growing at 80%. But the massive question remains, does the August 2026 earnings transcript actually prove that the turnaround is fundamentally real and accelerating? Or is this just a margin-engineered dead cat bounce in a market they've already lost? It is, without a doubt, one of the highest stakes battles in software today. Before you go, please remember that this explainer is strictly for educational purposes only. It is not investment advice, and absolutely everyone should do their own thorough research before investing in any company. Thanks for exploring the data with me today.